On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. Let's run through everything that we saw across financial markets last week, then let's talk about what's coming up in the week ahead. Share markets, a bit of a mixed bag last week. The S&P 500 index in the US slipped 0.3%. That's despite hitting a fresh high on Thursday. European and UK shares, they were stronger. They posted gains of more than 1% each over the week, while most other markets, Japan, emerging markets, Australia and so forth, they were all marginally lower. The local market, the NZX 50, ended the week down 0.6%. We still have lagged other markets around the world. Here in New Zealand, on a year-to-date basis, we are down 3.2%, while all of those other major markets that I usually talk about, the US, the UK, Europe, Japan, Australia, emerging markets, all of them are up by varying degrees this year. So New Zealand has very much been the laggard. Interest rates, US interest rates were up ever so slightly, not much. The US 10-year Treasury yield ended the week at 4.4%. Here in NZ, barely moved. The 5-year swap rate ended the week at 3.56%. That's barely changed from where it started. That obviously came on the back of a widely predicted no change decision from the Reserve Bank in terms of the OCR. We'll talk about that shortly. Tariff developments will again be in focus this week because we did see some news flow late last week. On Friday, President Trump announced a 35% tariff rate on Canada from August the 1st. Now, Canada is one of the US's biggest trading partners. Their biggest trading partners are Canada, Mexico, China, and the EU, not in that order, but Canada is definitely one of the biggest, so a 35% tariff rate on Canada. He talked about the flow of fentanyl as one reason for the higher rate. He did say that if Canada worked with him to stop this flow of fentanyl, then he will perhaps consider an adjustment to that rate. So we'll wait and see. Maybe there's some room to move there. Important to note that there is an exclusion for goods that are covered by the USMCA deal. That's the trade deal that replaced NAFTA in 2020. Between the US, Canada and Mexico. So that is expected to remain in place. So goods covered by that won't be affected by this potential change up to 35%, and also the 10% tariffs on energy and fertilizer also expected to remain unchanged. So hopefully this will mean that it's not quite as bad for Canada as that headline suggests. But we might hear more about that in the days ahead or over the course of this weekend. Trump also said he was planning blanket tariffs of 15 to 20% on remaining countries, so that's higher than that current 10% baseline. So we're waiting for more news on that. We're also waiting for an update on EU tariffs. And right now it's just after lunch on Saturday, so that's when I'm recording this. We might even get some news flow over the weekend if he chooses to post on Truth Social or anything like that. But anyway, that is where we are at. Right, in terms of key events and releases last week, it was really about monetary policy. In this part of the world, we had an RBA decision across the Tasman, and we had the RBNZ decision here in New Zealand. We got one surprise and one as expected result. So the surprise came across the Tasman with the Reserve Bank of Australia choosing to leave its cash rate unchanged at 3.85%. Now, most economists, and certainly financial markets, were very much expecting a 25 basis point cut to 3.6%. But the RBA left things unchanged. Apparently, they had to vote on this one, and I think that might have been the first time we've ever seen a vote by the RBA, so that is interesting. The reasoning in the statement was all about inflation. They said, look, inflation's fallen substantially since the peak, so that's good, but recent indicators have been slightly stronger than expected. So they're just being a little bit cautious. They did note that the cash rate was 0.5% lower than 5 months ago, and that economic conditions evolving broadly as expected, but they just felt they were able to wait for a little bit more information to just get confirmation that inflation is on track to reach 2.5% on a sustainable basis. So the RBA meets next month, mid-August, and markets see a cut then. So this is really just a timing issue. Markets expected a cut in July. They didn't get it. They expect that to come instead in August. The key thing to watch between now and then is probably that June quarter inflation report, which is due at the end of this month. So maybe that's why they chose to pause. They thought, look, there are some indicators that suggest inflation is coming up a little bit. We've got an inflation report coming at the end of this month. Let's just wait and see how that looks. And then if it's still something we're happy with, we'll just cut in August. So not a major, but we did see some reaction from financial markets because obviously that decision was not what people were banking on. Right, here in New Zealand, we had the RBNZ decision on the OCR, and they left it unchanged at 3.25%. That was widely expected by economists, it was widely expected by financial markets, so there was very little fanfare around it. Interesting that this was the first no change in a whole year. We've seen 6 consecutive cuts from the RBNZ that have taken the OCR from its 15-year high of 5.5% last year to its current level of 3.25%. So they didn't say a whole lot. Remember, this wasn't an MPS, so you didn't get the new forecast set. There wasn't a press conference. You just got that short statement. What it did say is that inflation was actually likely to rise slightly over the balance of this year, but the Reserve Bank does believe that that will be temporary, and they think that the spare capacity in the economy will likely see inflation fall back next year. So they're not too worried about that. They did talk about the risks to the global backdrop. They talked about the uncertain domestic outlook. But basically, I think it's not dissimilar to the RBA. They're just choosing to wait until the next meeting before they take any further action. They've already done quite a lot in terms of OCR cuts, and they're going to go a little bit slower from here. So I think the things we need to watch here in New Zealand as we look ahead to that August OCR decision and monetary policy statement, the key things we need to watch are next week's inflation report for the June quarter. Similar to Australia, that's not far away. So in that, the annual headline inflation rate expected to rise slightly to 2.6%, still in that band of 1% and 3%, but getting towards the top of that band. So we need to keep an eye on that next week, and then we need to watch out for the labour force report in the first week of August. I think it's the 7th of August, and the unemployment rate currently at 5.1%. The RBNZ expects it to push just a little bit higher to 5.2%. That would be almost a 5-year high. So inflation next week, labour force data in early August, and then you will obviously get that MPS and OCR decision. Assuming those two releases are fairly close to what the RBNZ is expecting, I think there is a good chance that you do see the 25 basis point cut in August. That would take the OCR to 3%. That's priced in currently to the tune of about 70-75%. So markets see that as quite likely. That would take the OCR to 3%. And then it gets really interesting from there. Is that the last cut? Is there more to come? What does that mean for mortgage rates, the housing market, the economic recovery, term deposit rates, and all of that? And I have got an episode and a report and a blog post planned this week to talk a little bit more deeply about what might happen next with the OCR and what that means for borrowers and so forth. So keep an eye out for that one. Probably be out Wednesday morning. Right, looking ahead to this week, and it is another busy week. We'll obviously be watching for more news flow on the tariff front. In terms of economic releases, Tuesday's US inflation report for June will be a highlight of the coming week, and later in the week we will also get the preliminary University of Michigan survey results. Those are out on Friday, and they'll give us things like confidence levels, but also inflation expectations. But the CPI on Tuesday in the US will be the key release. This will cover June. Last month, the CPI release was quite good. It came in below expectations, but markets are expecting a bit of a pickup for June. So forecasts suggest that we'll get a monthly rise of 0.3 at both the headline level and the core level. That'll be a 5-month high, and that would see the headline CPI on an annual basis up to 2.6%, highest since February. It would mean the core CPI rises to an annual rate of 2.9%, which is also slightly above the previous 3 months. So this will be interesting. It could be tariff related, although I don't think you'll see the full effect of the tariffs come through in the inflation figures until maybe August, but this could be early signs, and it will be important for Federal Reserve expectations. We've got the next Fed meeting coming up at the end of this month. No chance of a cut, I don't think, although when you look ahead to September, markets see about a 65-70% chance of a cut, and markets are still factoring in 50 basis points of easing this calendar year. So markets still see 2 cuts over the balance of this year. So US inflation on Tuesday will be important. China will also be in focus early in the week, with activity indicators for June out on Tuesday afternoon at 2 o'clock. So that's retail sales, fixed asset investment, some labour force figures, industrial production, that sort of thing. All of that comes out for the month of June, 2 o'clock on Tuesday. We'll also get June quarter GDP at the same time, and the growth rate is expected to moderate to 5.1%. That will be down from 5.4% in the previous quarter, so we'll be keeping an eye on that, and it will allow us to take the pulse of the world's second largest economy. So lots going on globally. Here in New Zealand, there's a couple of things to watch too. We'll get the latest REINZ housing market report at 9 a.m. on Tuesday, the Real Estate Institute report. This will cover the month of June, and things have been pretty sluggish lately. Last month, May, we saw an improvement in activity, but the days to sell increased, which means houses are sitting on the market for a little bit longer, and prices fell again. It was actually the 3rd consecutive month that we'd seen prices fall, and I think prices have been down 5 out of the last 6 months. So we haven't really seen the housing market fire away yet. It's stable, but it's certainly not doing a whole lot. Dairy prices, a day after that housing market report, Wednesday morning, we should get a fresh look at dairy prices with the latest global dairy trade auction results. Pretty disappointing outcome at the last one. A fortnight ago, we saw the index fall 4.1%. That was actually the 4th consecutive decline, and it was the biggest fall in a year. So prices are down about 7% from where they got to in May. They're still up this calendar year, about 2%, but currency moves are also proving to be a bit of a headwind, because the Kiwi dollar this year is up about 7.5% against the US dollar. So remember, it's early in the season, so too early to really make any calls about where the payout will land. Last season, the payout was $10, highest ever. This season, Fonterra also has a forecast of $10, but they've got quite a wide range. The range, I think from memory, is $8 to $11, and the midpoint of that range is actually $9.50 rather than $10. So, who knows? Maybe we're seeing a little bit of slippage back into the nines, but we should get a fresh look at dairy prices early this week, and that will allow us to sort of just gauge how things are looking globally. Right, last but not least, the June quarter reporting season kicks off internationally, and this will be big. We've got more than 40 S&P 500 companies set to announce results, and this will be a really important test for markets, because you've got indices like the S&P 500 sitting very close to record highs and trading above long-term averages on things like price-earnings ratios and so forth. So the expected earnings growth rate for the whole market is about 4.8%. So that's for the June quarter relative to the same quarter a year ago, growth of about 4.8, maybe 5%. That would be the 8th consecutive quarter of growth, so that's good. However, it would also be the lowest increase since the last quarter of 2023, the December 2023 quarter. So we are expecting to see earnings growth just taper off a bit. There are more headwinds out there. But look, growth is growth, and that's a good thing. 6 of the 11 major sectors are expected to grow earnings. Communication services expected to be the strongest. That's where Facebook and Google live. Communication services. Technology is expected to be second. Microsoft is in the technology sector, so is Apple. Amazon is actually in consumer discretionary. Can't remember where Nvidia is, probably technology. Energy forecast to be the only sector that will experience a big decline. I think earnings expected to fall about 20% for the energy sector. So more good than bad for the 2025 calendar year overall, because remember what I just said was all about the June quarter. For the whole calendar year, people are expecting earnings growth of about 9%, and that's expected to come on the back of revenue growth of about 5%. So that is where analyst expectations are sitting, and it will be really interesting to see whether the actual results support those expectations. Lots of really important businesses due to report this week. As always, we will start with the US banking heavyweights. They will kick things off all on Tuesday. Citigroup, JP Morgan, Wells Fargo, BlackRock, I think as well, all on Tuesday. So we will see them on Wednesday morning, New Zealand time. Then on Wednesday, you'll also get Bank of America and Goldman Sachs and Morgan Stanley. So Tuesday, Wednesday, or Wednesday, Thursday in New Zealand time, however you want to think about it. I always think about it in local time, so I'm thinking about it in US time and date. But financials will be very much in focus. Then you've got two of the big global semiconductor businesses that are reporting, ASML on Wednesday and TSMC on Thursday, and lots of other businesses across a range of other sectors throughout the week too. Johnson & Johnson on Wednesday, Netflix on Thursday, PepsiCo also on Thursday, on Friday 3M, American Express, Schlumberger. So lots going on across the week, both internationally and here in New Zealand. So take care everyone, and we will talk again soon. Thanks for listening.
For more insights, visit craigsip.com.